Welcome everyone. Thank you so much for joining us for this American IRA presentation titled Unlocking the Secrets to Financing Rental Properties. I'm Sean McKay with American IRA, and today we have the great privilege of being joined by a very good friend and a phenomenal mortgage broker, Mr. Bryan Maddex with Amerifirst Mortgage. Bryan, thanks so much for joining us, buddy.
Oh, thank you for having me, Sean.
Yeah, this is exciting for our client base. Usually they have to slog through hour of me speaking all by myself, so I think this will be a treat on a lot of levels today. Bryan's fantastic, as I said. He is my personal mortgage broker. We've done, maybe 8, 9, 10 deals together over the last few years, so he really knows his stuff, and he has a phenomenal team. So there's going to be a lot of great information here today. So really this will be kind of a two-parter today. The first smaller section will be just kind of the fundamentals of our service at American IRA, and that's specifically being self-directed retirement accounts. And that'll be kind of just a very brief overview of what our service is and how you can utilize that. And then certainly the main event, as I said, will be Bryan educating us on some aspects of how to understand home mortgages and in particular how that relates to investment properties and rental properties. So there'll be a lot of good stuff here today. Thank you all so much for joining us. We do have a questions feature on this webinar, so certainly feel free to type in the questions. I cannot promise that we will see them in real time, but the worst case scenario is we will have a Q&A section at the end, and we'll be able to dig into that, and that'll be helpful for everyone. So we'll go ahead and get started here. Okay, so when we talk about retirement accounts, I think certainly it's important to start with what we're currently doing as investors with our IRAs and 401ks. And so ultimately, many of us may work with financial advisors, maybe we sit down with a banker, and we identify some investment products that might make sense for us and for our financial goals. And so certainly as you look at the wide array of products out there, there are certainly more conservative products such as CDs and money markets where they're essentially guaranteed investment products. There's really almost no chance of loss of your principal. But certainly with that comes a lower rate of return. Your money is not going to be making quite as much money with those types of products. And as you move up the scale, you'll see products such as bonds, whether they're municipal bonds, corporate bonds, where you're creating a debt instrument with as I said, municipality or perhaps a company, a firm that is actually creating debt instruments. And those are largely typically seen to be pretty conservative products, and certainly they yield more than products such as CDs, money markets, treasuries, things of that nature, but they typically don't hit the range of double-digit rates of return and things of that nature. And many individuals certainly like to delve into individual stocks or mutual funds, certainly mutual funds being seen as a safer concept, because with that you are buying essentially a bundle of companies in one particular mutual fund or one product, if you will. And certainly individual stocks, there are investors that do incredibly well with those, and then there are times where, unfortunately, the company goes under, and you're losing your principal that you've invested in that. So there's certainly a wide range of investment opportunities that we're used to as investors. I think the challenge that we see amongst our clients is that when we do have the 2008s, the heavy recessions, there does seem to be the panic selling. And my gut feeling in talking to clients over the last 10 years at American IRA is that largely that tends to be based upon the fact that they don't actually understand what they're investing in. And so then, of course, they become nervous as they lose value in those stocks, those mutual funds, whatever the case may be. So ultimately, as we're bringing you these educational opportunities at American IRA, ultimately what we're trying to do is give you some other investment options to consider. We're certainly never suggesting a certain product to you, but ultimately we want you to invest in what you understand and what you're comfortable with. And if you do a great job of analyzing companies or mutual fund products, and that's gone well for you through different market cycles, then that's fantastic. That's what it's all about. But for those of you that get nervous and feel as though you have to make rash decisions at sometimes the inopportune times, then maybe that's an opportunity for us to look at our investment portfolio and see if there are investments that make us a little bit more comfortable, regardless of whether the quoted value is up or down in that particular day. So investing in what we understand is really the premise of the self-directed concept. Now, as we talk about a self-directed IRA or 401k, I want to make sure we understand two fundamental concepts. The first is that, as the name indicates, this is a self-directed account, meaning you as the account holder are making decisions for your portfolio. So this is very different than working with an advisor who may do kind of a risk analysis of what you're trying to accomplish and then make very specific suggestions for investment products that you should consider purchasing. With a self-directed account, you are the account holder that is making these decisions. We are not suggesting any sort of investment opportunities to you. So for better or worse, you are the captain of the ship. And so certainly, as I said, when we're investing in what we understand, our clients tend to get really phenomenal results from that. The second concept is when we're talking about what I consider a truly self-directed account. Keep in mind, we certainly have the ability to still invest in securities such as stocks, bonds, and mutual funds, but there's also this entire array of opportunities that's available to us, what we consider alternative assets. And that can be direct ownership of real estate. That can be being the lender or the bank for other businesses or individuals that are looking to make investments. And that can be investing in private placements, so a privately held company or opportunity, which certainly is different than a publicly traded company that's traded on the different exchanges such as the NASDAQ. And then also physical precious metals is also something that we see clients invest in. So physical gold and silver can also be acquired by your IRA or 401k. Now, at American IRA, we are considered the third-party administrator for your retirement account, meaning that we are essentially the record keeper for your IRA or 401k that we are holding. Now, we are what's considered a fully integrated company, meaning that New Vision Trust Company is our custodian, and Mr. Hitt is the CEO and founder of American IRA, and he is also the principal of our custodian, New Vision Trust Company, and sits on that board for our custodian with some other great minds that are kind of helping to lead us in the proper direction. So we are fully integrated, so really you do not need another financial services company in the mix to make these investments, these self-directed investments. It is all in-house, if you will. Now, we're never going to be a Bank of America in terms of the scope of our company. As I said, we provide kind of a niche service with these alternative opportunities. So we have currently a little over 400 million in assets under administration, which is pretty substantial for a self-directed firm, but as I said, does not compare to the Bank of America's, to the Wells Fargo's. And quite frankly, we don't have the scalability to bring in 10,000 new clients over the course of a week or a month. And so ultimately, what you get with us at American IRA is we're very much like dealing with the local bank. You're going to find that you're going to have team members at American IRA that you work with consistently for the purchase of an asset, for the sale of an asset. And the great thing about our firm is we have a lot of continuity in-house, meaning that our senior team members have been with us many times for 6, 7, 8+ years. I've been with this firm for the past 10 years. And so what you find is there's this culture of, as I said, continuity, of understanding the needs of our clients and being able to spend that time with you because we are that smaller firm. And so ultimately, we find that that's a value add for our clients, especially considering that many of us are investing in these alternative assets inside and outside of our retirement accounts. So you're not having a theoretical discussion about how a rental property may flow. You understand that when you're working with some of these team members, we are actually landlords ourselves, and some of us have built up pretty sizable portfolios of rental properties and other assets. So I think that is a real value add when you're dealing with people that are also investors themselves. And also the fees associated with our service are really almost revolutionary in the self-directed space. What you typically find is that most firms are charging their annual fee based upon the size of the account. So as your account balance grows, so does your annual fee. So when your account hits $200,000, it is significantly more expensive than when your account was $50,000 or $100,000. Our model is that since we are not picking investments for you, we shouldn't see the upside in the balance of your account growing. And so thus, we have a set flat annual fee. If your account balance is less than $7,500, the annual fee is $165 a year, and $7,500 and over, your annual fee is $285. So whether that account balance is $7,500 or it is $7,500,000, that annual fee is still $285. Also keeping in mind, cash accounts, we do not charge these annual fees. So if you open the account and let's say a few months later you fund that account and then 3 years goes by before you make a self-directed investment, 3 years from now will actually be the start of that annual fee, as I said, of either $165 or $285. So we do everything we can to make it as cost effective as possible for our clients. Now, when we use the term self-directed, I think sometimes there's a bit of a misunderstanding that you're somehow creating a totally separate retirement account. And this is actually not true. If you currently have a traditional or sometimes called a rollover IRA with Wells Fargo, for example, you're also technically opening a traditional IRA with us at American IRA as well, assuming you're going to move a portion of that account to us. The key is, as we said, we're calling it self-directed, meaning you can go beyond stocks, bonds, and mutual funds, but the mechanics of your retirement account are not changed. So really, self-directed is really, frankly, a marketing term that we use to indicate that you are the decision maker and we can go beyond securities-based assets. So all IRAs can, in fact, be self-directed, whether they're Roths, traditionals, SEPs, simples. Also, this is kind of what I consider second-level accounts, such as Coverdale's, which is an educational account for minors, or health savings accounts can also be self-directed. Now, the one time where your account will typically change forms is if you're moving over an old employer-sponsored plan to another firm. So if you have an old 401k, an old thrift savings plan, or a 403b, many times that will roll over into another pre-tax account because typically those are pre-tax accounts. So that would many times roll over into a traditional or a rollover IRA. So you're not creating a taxable consequence. It is simply going from one firm to another. And so ultimately, keeping in mind, certainly we have many clients that move over their entire balance to us, but it is very possible and it is very likely that you may consider just simply moving a portion of your monies to us. So if you have a $80,000 Roth IRA, you may decide to move over $30,000 to American IRA for some specific investment opportunity that you've identified. Also keeping in mind, I think this is something that unfortunately the tax arena, tax professionals maybe sometimes fail to mention, is that many times, even if you have a spouse that does not work outside the house, you can also make contributions typically for that spouse without a W-2 or 1099 income. So spousal accounts and certainly inherited accounts are great tools to utilize in the self-directed space as well. Now, ultimately, the way the IRS code is written is it tells us what we cannot invest in with our IRAs and 401ks. So this is by no means a complete list of investment opportunities, but ultimately any type of physical real estate can be owned by your self-directed retirement account, whether it's raw land, condos, townhouses, single-family houses, commercial buildings, industrial buildings, retail, shopping centers. These can all be directly owned by your retirement account. Now, many times what we'll also see is, especially on larger deals, that these retirement accounts are actually partnering with other individuals or companies or retirement accounts and owning a portion of that deal. So many times we'll see clients that will use their retirement account to invest into LLCs, for example. So that LLC then goes on to acquire the apartment building, whatever the case may be. Now, sticking with that real estate theme, there's also the ability for the retirement account to be the bank and to actually create with the borrower either a deed of trust or a mortgage, depending upon the state you're living in. If you're kind of local to our region, North Carolina, for example, is a deed of trust state, while South Carolina is a mortgage state. And frankly, many times clients will use the term mortgage depending upon the type of state that they're investing in. But basically, it's creating an instrument. As Bryan Maddex is a terrific lender, Bryan Maddex's company is going to be lending money to investors in North Carolina via a deed of trust. Now, also, there's other opportunities such as tax liens and tax deeds, which we cover in length at other webinars, but just want to give you a flavor that essentially most investment strategies can be done with these retirement accounts. And as I mentioned earlier, investing in privately held companies, we're seeing a lot of private stock offerings where, let's say there's a local bank that's forming and they are raising capital to start that bank. You can invest in that opportunity via your IRA or 401k. So a lot of exciting concepts out there. So at this point, I will go ahead and I'll turn this over to Mr. Bryan Maddex with Amerifirst. And Bryan, let me know if you have the controls now.
Looks like I do.
Okay,
thanks,
perfect.
Sean. So, quickly a little bit about myself. I am a real estate investor. I own a couple of long-term rentals. I have a short-term rental. I've done lending out of a self-directed IRA. I have seen very, very thick tax returns. So when it comes to the mortgage world and the investor world, I kind of have a glimpse at the traditional mortgage world as well as what a lot of investors are doing. And by no means am I a super creative guy. And there are a lot of creative people that come to me with questions that exceed my knowledge, but I try to hang out with some pretty smart people. And I think that in this arena, for especially clients that might be finding this webinar, hopefully being able to kind of understand what you're trying to do and then also understanding the financial products available, hopefully I can help make some things easier for you. So kind of put a presentation together to kind of talk to you about some different financing options, many of which I do, some of which I do not do, but hopefully you guys will leave here with some ideas, and I have a gold nugget at the end, kind of dangle that carrot out there to keep you listening and participating. Let's see. So today, what we'll do is we'll go over the traditional bank financing options, and that's going to be your long-term mortgages in your personal name, your non-traditional bank financing options, which some of them might be in your personal name, some of them might be an LLC, financing inside or alongside of your IRA. I get that question a lot of times, and I'm sure, Sean, you're going to be much wiser in this arena than I am, but it is a question that comes up a lot of times for rental properties, so I thought we would include that. And then that number 4, how to acquire rental properties that need renovations with very limited money out of pocket. So I tried to create the longest name for a slide I could. All right. So traditional financing, this is your typical 30-year fixed rate mortgage. It's the gold standard. It's typically going to be the cheapest interest rates, 30-year fully amortized, no balloons, no prepayment penalties. You've heard the term Dodd-Frank or TRID or QM mortgage. This is full doc, going to a bank, getting your traditional financing. So we're going to do full document of income, typically through your tax returns, W-2s, pay stubs. We're going to look at assets, 2 months, bank statements. We don't want cash. Your mattress money is not going to be involved in these types of transactions. Your IRA is not going to be involved in these transactions. It can be used as reserves, but it's not going to be part of your purchase. So when we talk about the traditional mortgages, you can have up to 10 mortgaged properties. So you could have a blanket lien on 8 properties, right? So it's one loan, but that still counts as 8 mortgaged properties. So we don't look at how many loans do you have in your name. We look at how many properties are secured by lending. So on your first 4 transactions, you can do as little as 15% down on investment. If you own a primary residence, that counts as 1. So you could buy 3 additional investment properties and do as little as 15% down. Once you get to 5 or more, you need to put down at least 20%, and then 25% down payment on multifamily properties. When we look at doing cash out refinances, 75% is going to be the max loan to value that we can do on a cash out refinance. Fannie Mae requires reserves no matter how many investment properties you have. So typically it's going to be 2 to 6% in reserves. And that number has changed the way they calculate that in recent years. They now look at the total aggregate outstanding balances on your mortgages. And then they want to have a percentage of that aggregate outstanding balance. So if you owe, $1 million in different mortgage products, and that could be HELOCs or lines of credits or blanket liens that are spread across multiple properties, we're going to want to have a 2 to 6%, depending on how many how many properties you have, is going to determine if it's 2 to 6%. I think you go to 6% when you're at 6 financed properties. Interest rates today, as of November 5th, at this exact moment in time at 12:22 p.m., the rates are going to be generally around 5.75 to 6.25 for your investment properties. And the range is going to depend a little bit on your credit score, the loan to value, the type of asset that's being used for collateral, and then the terms. So if it's 15 years, you might get a little bit cheaper, but 15 years hard to do on investment property. So these are typically going to be your 30-year interest rates. And then we can close these transactions typically really quick. We can do it in 8 to 10 days. We can do fully underwritten pre-approvals. So you can go out there and compete with cash offers a lot of times. Many people that are doing cash purchases are still going to want to do a title search, and they're still going to want to do an appraisal. And that's normally going to take 5 to 10 days for most of those types of transactions. So if we've got you fully underwritten, fully pre-approved, we only need to do the same 2 things: title, appraisal, and we can get you into that home. So I have a lot of investors that will go out there and compete in the marketplace, and oftentimes they'll win the bid, and they'll tell me that they got the bid on the house in a multiple bid situation, not because they had the highest offer, but because they had the quickest offer. Especially if there's a vacant house, if it's from another investor, they've got holding costs. They want to get their money back into a new property and back to work. They don't want to be sitting there having their funds tied up for 30 or 45 days when a traditional bank is taking that long to get to a close. So that's basically your traditional financing options. Sean, is there anything I left out of there? You're pretty familiar with typical financing.
No, you hit it. Thank you. That was good.
So some non-traditional financing. Generally, we're going to have higher interest rates, shorter terms, balloons, prepayment penalties. This is going to be anything outside of that standard 30-year fixed rate mortgage that you're going to get in your personal name. So if you want to get your LLC involved, you're going to need to go to a commercial lender or a business, a bank, and get that financing. And they may do a 15 or 20-year term, and it might be ballooning in 5 to 7 years. So you may have an amortization schedule that's longer than your balloon. A lot of times they want to just revisit you as a borrower, and they want to have an opportunity to go back and look at your financials, look at your credit, see what your debt is, and see if they have the appetite to continue to lend to you. So 5 years or 7 years, sometimes 10 years is not abnormal for them to want to refresh and relook. Also, interest rate environment changes. We're in an increasing rate environment, and a lot of the smaller banks who do the little bit crazier financing, they may need to have that capital, that investment into your mortgage or your loan. They may need to have that kind of refresh with the current market rates. So they may want an opportunity to go and negotiate with you on the terms that you're borrowing. Some of the other terms that you'll hear is non-QM lending. That's going to be basically your subprime lending in the past. It's not the same as a subprime lending was in the past, where you needed to just fog a mirror and you could get a loan. They're going to look at some assets. They're going to look at some income in different ways. They're going to look at reserves, and they're going to want you to have some skin in the game in most cases. There's hard money lenders out there, and I would consider a hard money lender as an institutional lender, someone who is not lending out of their own personal IRA or is not a sole decision maker in that. They're going to be a company that's designed for long-term lending. Sometimes they'll do more short-term lending for your fix and flip type stuff. Sometimes they'll do 30-year or 25-year long-term lending that's designed to be for rental properties. There's a number of lenders in this area that I can think of off the top of my head. If you guys need some referrals, please email me and reach out and we can discuss some of those. There's private money. I would say your private money is a lot of your self-directed IRA investors who they do lending out of their IRA, and the rates and the terms are 100% negotiable. If they want to charge you 20% and get interest-only payments every month or quarterly, you can negotiate that. If you want to pay once per year, you can negotiate that. You're really off the books. There's no set standard when it comes to private money. It's all about you and the lender having a mutually beneficial arrangement when it comes to that lending. So if you like the terms and they like the terms, you guys do business. So they can typically close in your LLC. A lot of them will not lend to you personally because they don't want to get into that protected arena of lending where they need to be licensed. Commercial loans and liens and lines of credit, you can do blanket liens, multiple assets in one loan. You can do one loan per one property. You could do seconds. You could do lines of credit that are kind of like an equity line over multiple different properties. Again, it's all negotiable. And then you've got your business loans through your local banks. Sometimes I'll recommend to people, especially when it's a small property that they're purchasing, it's $30,000 to $50,000 as the acquisition cost. It doesn't make sense to come to me to do lending in that nature because we've got to do everything, full doc, appraisal, title insurance, attorney, closing fee, all of that. So closing costs and prepaid items for your taxes and escrow setup are going to usually run $4,000 to $5,000, even on a property that only costs $30,000. So if you look at the cost of the lending in comparison to the amount you're borrowing, that's a pretty steep premium. And oftentimes it's just not even possible to get that loan to be legal. We're limited on how many points we can charge in order to get the interest rate to absorb the risk for that loan type. And a lot of times it just doesn't work out. So financially, we just can't make the deal work without it being illegal. We just can't charge enough points or fees to do that. So go into a small bank. Typically your kind of micro branches, they might have 3 or 5 or 10 branches across your region. Those lenders are oftentimes going to do things that the big banks aren't going to do. They oftentimes have an appetite for the small one-off investment properties or the small kind of blanket lien on several. A lot of it's relationship based. So having your deposits there, having other loans that you've done with them and building that relationship oftentimes really helps determine what you're eligible to go out there and get. So it's going to be a good source of money for you as well. So I want to focus down a little bit more on the non-QM options. There are a number of non-QM lenders out there. I do broker to one of them, and so I can speak to the guidelines of the products I have access to. And there's about 3 or 4 major players in the market that I'm aware of, and I'm sure there's a whole bunch of minor players that I'm not aware of. But generally speaking, for investors, they're going to want to see a 660 credit score. You can close in the name of an LLC a lot of times, but they're still going to base the lending off your personal credit. They have multiple ways of looking at income. They can do full doc. Obviously, the more documentation you provide, the cheaper the lending is going to be. So if you are able to show tax returns and pay stubs and W-2s, you're going to have a much better interest rate than if you can't show any of those things. There's more risk. The less documentation you show, there's more risk. And so the non-QM lenders, I call it responsible subprime lending now. They're looking at that risk and they're adjusting the pricing based on that risk. So they may want a little bit more down if you're going to provide less documentation. If you're going full doc, you might be able to put as little as 15 or 20% down. But if you're doing no doc, you might need to put 20 or 30% down. And a lot of that's going to depend on what your credit score is. So bank statements, they've got an option to look at your personal bank statements or your business bank statements. Again, if they're looking at your personal bank statements, that's a little bit more open. There's a little bit less risk to that. So you're probably going to get a slightly better interest rate than if they're looking at your business bank statements. They even have products out there that are 100% no doc. So you don't have any financial statements at all. You're not giving them tax returns, pay stubs, W-2s. You guys have heard of the 4506T form that allows banks to pull your tax records from the IRS. We don't even get you to sign a 4506T. That's going to be a no doc loan. So some people think no doc and everything stated assets, stated income, and we're not to that point. We're going to look at assets. We're going to see where did you go, where do you have this money, and is it yours? Did you have to borrow in order to get this money? So if you've got large deposits in those bank statements, we may ask to source those and see where those funds came from. A lot of times investments into condo associations is not allowed for investors because of the amount of investors that are already into that project. Fannie Mae gets really sensitive when it looks at the HOA and approving that HOA itself. So this product allows you to have 100% investor owned condos. So, that's a non-warrantable condo is another term for that. So Fannie won't do the lending on that, but this investor will. And then of course, interest only options on there. I've got a little golden nugget for you, Sean. Are you ready for this?
Let's get it, buddy.
All right. So you are an amazing investor, right? You're probably one of the smartest guys I know.
Oh, no. Let's keep in the realm of something people can believe, but okay.
Okay. So let's say you're an average investor, but you find a really good deal. You can spot a deal, right?
Theoretically.
Hopefully.
Yeah.
Theoretically, you might pass it by another couple of guys and say, hey, is this a deal?
That's right. If you and 5 other people like it.
The goal would be you find a property that's got some meat on the bone. It's got some equity that you can get to. Either you're just buying it right because of the situation of the seller, or you spot an opportunity to do some renovations and clean up this property, and you're going to have a new value to that property after you go in and do some work to it. So when we're looking at properties in this situation, we want to look at that ARV, or the after repair value. So you've got a property, it is $150,000 ARV, right? So this is a good deal. I'm buying it for 60 grand. I'm going to need to put some work into it, maybe 40 grand. And then at the end of the renovation, I've got some meat in this bone. I've got a lot of equity that I have available to me. So people will come to me and they'll say, hey, Bryan, I want to finance this property. In the mortgage world that I work in, we've got to look at the purchase price or the appraised value, whichever is lower. And people don't like that because they say, well, the value is 150 grand once I do some work, and I'm buying it for 60. So I'd like to borrow, based on the current or the after repair value. And I'll tell them I can't do that, unfortunately. For the first 6 months, I have to use that purchase price or appraised value, whichever one is lower. So in this case, a purchase price is 60 grand. And I just told you, Sean, that I need to have at least 15 to 20% down on that property, right? So your loan size is going to be under 50 grand. I'm probably not even going to be able to finance this deal for you, honestly, because it's under $50,000 in the traditional world. So let's say you buy the property with your own cash. You buy it for 60 grand, and then you repair the property. You spend 40 grand. You get it up to being a really good and a resale value now of $150,000. So now you come to me and you say, hey, Bryan, I bought this house for cash, $60,000. I put $40,000 of repair work into it, and it's now worth 150 grand. I would love to get my money back out of this deal. Well, for the first 6 months, I've got to go by the lesser of the purchase price or the appraised value, and I still have to use that number. So when you come to me, I say, okay, I can give you, 75% of that 60 grand back because now we're doing a cash out refinance. And you're saying, well, I just put 40 grand into it. Well, that's great. I can't give that to you because that wasn't in the purchase price. So I get a lot of investors who get frustrated because they want to get their money back to go do another project. So now what I advise a lot of clients to do is, instead of coming to me, and especially instead of using your own cash, go to a hard money lender or a private money lender. Find someone with an IRA or find a hard money lender that will lend to you based on the after repair value. Many times, you can find 70% ARV lending. So they'll take the 150 grand, and they'll look at your budget and they'll say, okay, you need 40 grand for repairs, you need 60 grand for the purchase. So you're 100 grand in need of a loan and an ARV of 150 grand. They'll do that deal. Some of the lenders out there won't even have you put any of your own money into that project. Some other lenders, they might say, hey, we want to see 5 or 10% of your own cash. We want some skin in the game. So the goal is get all of that lending in one note. Go get a hard money loan for $100,000. Okay. Even if you don't need it, you got 40 grand in the bank and you don't need it. But the goal is we want to keep that 40 grand in the bank. And in order to put all 100 grand into a long-term debt vehicle, we need to have that acquisition loan be for 100 grand. That's going to pay for your purchase price and all your repair costs. And now when you come to me and you say, hey, Brian, bought a house for 60, I put 40 into it. I did all that in one loan from a hard money lender or a private money lender. Can I refinance that? Now I can do that right away. There is no seasoning to that. You don't have to wait 6 months. I'm no longer looking at doing a cash out refinance. I'm just doing a rate and term refinance. So I don't have to have the lower of the purchase price or the appraised value because we're not doing cash out. I can do a straight refinance right away. So this is how you can go out and buy a house with no money out of pocket and get long-term financing in place as soon as the repairs are done. How's that, Sean?
That's beautiful. I think that is confusing for a lot of us too, that 6-month window and the way you structure the note. So thank you for that.
Yeah. So on this transaction, it's just like a renovation loan from a bank. You're going to have the seller get paid their 60, and then you're going to have funds put aside for the repair costs. So on your CD, you're going to have 2 different line items, one for the seller and one for renovations. That lender may keep the money in their escrow account, and they may have you do draws. They may give you a check and have you be responsible. Every lender is going to have that part be different. But the goal is once you come to me, I'm just going to ask, what's the payoff? Let's go get a payoff statement from that lender, and we can change the ownership of the asset is typically going to be in an LLC because most hard money lenders won't lend you personally. So they're gonna have this done in your LLC right before we order the appraisal. I'm going to have you switch that into your personal name. You can go do a quick claim deed and switch that over. There is no seasoning requirement for that, but I cannot close in your LLC in most cases. There are some of those non-QM options that can do the same exact thing, and they could close in an LLC, but you're just going to have a higher interest rate for that. So, so that's what I've got, man. That's a couple of different ways to look at financing for a house. And I'd be way open to any questions that you may have or any of the listeners that are on the webinar here. If there's something that I can do for you, please let me know.
Perfect. Thank you. All right. So what we'll do is I'm going to take this back. Okay. So final slide here. So again, we do have a questions feature on this webinar here today. So please feel free to type in any questions you have. Certainly, if you have a individual question you're not interested in having answered on this webinar, feel free to contact Bryan. His contact information is here, Maddex at Amerifirst.com. And the office number is 704-246-3833. And again, that's Bryan Maddex with Amerifirst. And I'm Sean McKay with American IRA. My email is Sean, SEAN, at AmericanIRA.com. Our headquarters is in Asheville, North Carolina. That number is 828-257-4949. We do have a sales team over there that's fantastic. If for whatever reason you need to speak to me individually, certainly feel free to call me on the Charlotte number. I apologize that's not listed, but that is 704-633-8155. I do ask you bear with me. I am typically the only team member in the Charlotte office, so the sales team in Asheville is typically more available. So we'll go ahead, and if you could bear with me here, let me just open up the questions area, see if we have anything. Okay, great. We got a few already. All right, so obviously these are largely, Bryan, going to be based on questions for you. So if you don't mind, I'll just swing these over to you.
Sure.
If you have more than one asset class, oh, I'm sorry, this one's actually self-directed based. If you have more than one asset class, do you charge additional fees beyond the annual? Great question. So with our fees, there is a reoccurring annual fee of the $165 or $285, depending upon whether it's under or over $7,500. There's also a transactional component. The bulk of our work is done when you purchase an asset or when you sell an asset. So you can make a single transaction, a single purchase or sale during that year for $95, or you can do unlimited transactions for $165 a year. Beyond that, it's just simply bank fees. So wires are $30 and outgoing checks are $10 check fees for that. So thank you for that question. Okay, next one is Amerifirst only in South Carolina, South Carolina, Florida? Bryan, if you want to take that one.
Yeah, so we are in, I don't remember exactly how many states. We're mostly in the Midwest, and then we also have the Southeast region, so we're in Florida. We have people that are licensed in Alabama, but they don't sit there, as well as Tennessee. We don't have any offices in Tennessee. I personally am licensed in North Carolina, South Carolina, and Florida. But if you've got a transaction, you're looking to do something in the Midwest, the Southeast, and we just got a California region open as well. So if you go to Amerifirst.com, you can click and see exactly which states we're licensed in and which states we're actively lending in.
Perfect. Will this presentation be made available to the attendees? Yes, it will be. I'm going to hedge by saying, assuming we can work out one or two of the challenges we're having with the GoToWebinar platform. Certainly is the goal. We've recorded this. So yes, that will be the goal, and hopefully we will be able to upload this actually to a landing page. Unfortunately, Bryan and I did a webinar a few years ago, and being the genius that I am, I've failed to actually record. So we're through that hurdle, and hopefully we can get you the material afterwards. But thanks for the question. Is it possible to get a copy of this webinar? Yes, and certainly at the very least, we can always swing over the slides to anyone that reaches out to us. We can get you the PowerPoint slides, and then the audio, as I said, that's certainly the goal. Some kind words. This has been great info. Where do we get the recording? Thanks for the webinar. Okay, so my question is related to Bryan's last example of refinancing before the 6-month refinance conditioning period. So if I followed correctly, in the example, I borrowed $100K for purchase and repairs. As soon as the repairs are made and a tenant is in place, I can refinance, ?
That's a great question, and yes. So you don't even have to have a tenant in place. If we need the income from that property, what we're going to do is we're going to order an appraisal with a market rent analysis. That costs an extra $150. So I always say, if the income from the property is needed, we can order the appraisal. You don't have to have a tenant. If you have a tenant in that property, it actually doesn't matter if it's occupied or not occupied by a tenant. In either condition, if we need that income, we're going to order the appraisal with the market rent analysis. If your income supports the debt, we can save $150 and we do not need to order that market rent analysis. But yes, what we can do is we actually, as soon as you purchase a property, we can start an underwriting. We can get the loan approved, we can get all your docs in, and we can just sit back and wait for you to finish those repairs. Right when you're finished, we can order that appraisal. So you know your schedule, and I've got some people that will tell me, hey, Bryan, this house will be done on Monday. It's Friday. Let's go ahead and order that appraisal today. So my next advice to them would be go switch. We've already hopefully gone through underwriting, and we've already gotten your loan approved subject to the appraised value coming back. So we can now go order the appraisal, switch the title back into your personal name, get that appraisal in, and generally close within about 3 to 4 days after that appraisal comes in. So we can be very quick about getting the financing ready to go and closing as soon as possible so that you can get out of that hard money or private money loan, which may be a little bit more costly than the long-term Fannie Mae loan that we're getting you into. So yeah, you can certainly do that right away as soon as your repairs are done.
Perfect. Great. Thanks, Bryan. And also, just to clarify, that was a great example. And just so that we're all aware, that example was for an individual that owns or is purchasing this property. Really, our goal is to kind of have a value-add educational platform. So that specific scenario does not really relate to these retirement accounts, but I just thought it would be helpful to have a really phenomenal mortgage broker talk about just overall investment concepts and rental properties. So just to be clear, that's not a retirement account specific loan product.
Yeah, Sean, actually, if your retirement account is involved in this transaction in any way, I cannot do that lending because those retirement accounts are going to be protected assets. And you need to look for a non-recourse lender, which I don't do non-recourse lending.
Exactly. Yep. Thanks, Bryan. This has been great info. Where do we get the recording? So the goal is, once we have the audio, to actually send a link to the attendees so that you have both the PowerPoints and the audio associated with this. So keep your fingers crossed we can get that accomplished. Did I hear correctly that you guys offer financial or portfolio planning directly or indirectly? So I apologize. So if there's some confusion there, American IRA, we do not offer any sort of guidance in terms of how to structure your financial portfolio, your asset portfolio. Really, our goal is to simply make you aware of asset classes that can be acquired by your retirement accounts, but ultimately we are just simply the record keeper for your assets. So certainly it is always prudent to speak with your attorneys, your CPAs, and your financial advisors as to what might make the most sense for your portfolio. So we are kind of the low man on the totem pole, if you will. We are just simply providing this avenue for you without giving you guidance as to what makes sense based upon your goals and what have you. Let's see. Does American IRA do solo 401ks as well as IRAs? Yes, we do. So solo 401ks is a popular product for individuals that are self-employed and do not have full-time employees other than perhaps a spouse working in the business or what's considered a highly compensated employee. So that's kind of a whole element to get into, but yes, that is a great retirement tool for those that qualify, and those can be self-directed, and we do have those at American IRA. So great question, thank you. Could you go over again how the non-cash in investment work? So Bryan, that was a great example. If you don't mind just kind of bullet pointing or the overview of that again.
Okay, so let's go back to that slide.
Okay.
I think you have control.
Bear with me here.
So in this example, if you can get the hard money lender to come up with all of the deposit or all of the purchase price and all of the repair cost, you could literally have none of your own money into this purchase, right? So that hard money lender is going to give you the loan based on the ARV. Oftentimes they'll go up to 70%. You might find some that go a little higher or a little lower, and you may find some that want some skin in the game. They actually do want some of your own money invested into this project. So you just need to check with those hard money lenders or private money lenders. But if you buy the property and get the repair cost all bundled into one single loan, then that loan is considered a purchase money loan. And when I refinance that loan, I'm not doing a cash out refinance. When we look at trying to get access to the equity in a home, you have to own that property. You have to have seasoned that property for 6 months. You can season that property in your LLC if it's wholly owned by yourself or in your personal name. And once you have a 6-month seasoning, then we can do cash out refinances. When we do cash out refinances, there's typically a little bit higher cost because we're giving you access to money that was not involved in the purchase. So you're actually tapping into equity that you didn't have prior. So that is a slightly riskier transaction. So if we're looking at doing a cash out refinance, then we need to have 6 months of ownership and we may have a slightly higher interest rate. if we're getting a hard money loan or a private money loan to purchase and finance the repairs, then I can refinance that hard money loan as soon as the repairs are done, as soon as that equity is available to you. So we have to order a new appraisal, and we have to see that the repairs that you made do get to that ARV. Now, when we're doing a refinance, a lot of people ask me, hey, this didn't come in with the value that I thought it would. Well, when you purchase a home and you get an appraisal, that appraiser has a line in the sand. Subconsciously, they see your contract and they know what you've offered on that property. So they're going to do what they can to justify that purchase price. They're not always going out trying to give you an independent valuation of that property. What they're instead doing is trying to value that purchase based on other purchases of similar homes and seeing what those purchase prices were. So when we do a refinance, they don't have a number. They don't know how much you owe. They don't know how much equity you need. They're only going out trying to find other similar properties in that new condition. So if they can't find in your area a lot of properties that have the upgrades that you put, you may not get a 150 ARV. So there's never a guarantee that we're going to be able to do this loan. It all depends on what that appraised value is. You may be asked to bring some cash to the table, because when we're doing that refinance, we can only go up to 75% of the appraised value. So in this instance on this slide, $150,000 property that you're buying for 60 grand, you can get this property for no money out of pocket. You have to create that equity with the repair cost. Does that make sense, Sean?
Absolutely. Perfect. And I believe you've touched on this before, Bryan, but in terms of the number of conventional loans that investors can get, can you give us the metric for that?
Yes, we can finance up to 10 financed properties or 10 mortgaged properties. Again, it doesn't matter how many mortgages you have, right? So it could be one loan that's on 8 properties. That now is 8 financed properties. Now, that's when you're purchasing an investment home. You can only go up to 10. If you have 15 or 20 financed properties, I actually can always do your primary residence. So there is no limit to that. You also can go to those non-QM products, and you can go beyond the 10. So when we talk about having a limit of 10 properties, that's a Fannie Mae condition. So Fannie Mae allows up to 10 financed properties. Non-QM lenders, they'll have an unlimited number of properties that you can have financed, but they may limit how many they're willing to do to you. So for instance, our lender may only do the one that we broker to, they may only do 3 to 5 properties. I have to check their guidelines. It's somewhere between 3 and 5. It might be 4, and it might be 3, and it might be 5. But they'll do an additional 3 to 5 properties for you as an individual investor on top of the 10 that Fannie Mae financed for you. So they may not have a limit to the number of properties you can have financed, but they themselves will only do a certain number for you.
Perfect. And has Fannie Mae changed the guidelines? I believe you've always said it's personally owned finance properties, right? So you could have properties in an LLC, but if you only have personal mortgages for, say, 3 properties, you can still get up to that 10. Is that correct?
Yeah, that's a great question, Sean. Fannie's going to look at those properties that are either in your personal name, so you own that property, or the debt is in your personal name. So a lot of investors, they'll come to me and they'll purchase an investment property in their personal name, and I do the loan in their personal name, so they own the asset that's in their name. After I finish the financing, they'll switch that asset to an LLC. They've got guidance from their CPAs or their attorneys that that's a good idea. So they'll switch that asset to an LLC. Fannie Mae is still going to count that property against you, even though your LLC technically now owns that property. The loan is still in your name. So if the loan or the asset is in your personal name, we're going to count that as a financed property.
Perfect. Perfect. All right, great. Let's see if we have any additional questions. Yes. So as kind of an offshoot to that example that you had, Bryan, is there a limit to how many loans you can make using the strategy you mentioned, i.e. traditional max is 10, then you have to head to commercial portfolio? So I guess maybe the question revolves around the no money down, going from the hard money kind of bridge loan to this commercial, or excuse me, this conventional long-term 20 or 30-year fixed. Is there a limit to how many of those you can do?
Yeah, that would follow under that 10. So I can only get you 10 financed properties through Fannie Mae. So this example was a perfect example of how to get access to as much financing as possible using Fannie Mae cheap money. So you can naturally do other types of lending, and they may have their own requirements. Fannie Mae seasoning is 6 months. Many banks, they want a year of ownership before they let you tap into that equity. So you may have an opportunity to do some of that same type of lending through some portfolio loans from different banks, or through some commercial products or business bank products. So you would need to talk to them and find out what their guidelines are to see if, in this same example, they would allow you to refinance that debt into their long-term mortgage or loan right away, or if they would have their own separate seasoning requirement. Fannie Mae would let you do that right away, so only up to 10 for Fannie Mae.
Okay, perfect. Thank you. So the next one, Bryan, if you don't mind, I'll jump in initially, and then if you have anything to add to that, please do so. How do we finance a property purchase for our self-directed IRA using IRA funds for a down payment? Great question. So we'll make the assumption that ultimately the end result you're looking for is for the retirement account to own this property. So certainly it will be for investment purposes. It's a rental. It's maybe a fix and flip or spec deal, something like that. So a retirement account itself can get a very specific type of loan called a non-recourse loan, meaning that you as the account holder are not personally guaranteeing the debt. So it's strictly a asset-based loan, as some big commercial deals are done. So that's the most typical debt strategy. Sole retirement account, it gets a non-recourse loan, and then it is the sole owner. We do see clients that will partner retirement accounts with other retirement accounts or individuals. This is beyond the scope of this presentation, but there is the ability for the retirement account to partner with the account holder. There are some specific rules that go with that, mainly that every part of ownership has to be strict to whatever you articulate on the front end. So for example, if the IRA owns 30% of the house and the individual owns 70% of the house, everything will be split 30-70 from the earnest money, the acquisition, the repairs, the income. Everything will be split in that 70-30 metric there. So that's most typically what we see. And then also, just keep in mind, if you're working an off-market deal and you get some sort of seller financing, the retirement account can do the down payment, and it can get debt with the owner, the seller of the property, a seller finance scenario. In some states, like North Carolina, for example, I'm not an attorney, but by definition, a seller finance note is a non-recourse note. So all they could do in case of a default is simply take the property back. South Carolina, other states, you want to check on that. I don't believe South Carolina is the same. So that's kind of rushed through that overview there. Maddox, do you have anything to add to that?
Yeah, the only thing I know about the non-recourse loans, if you're going to a major bank that does those or a company that specializes, is they're normally looking for 30 to 50% as a down payment. They're not going to lend you 100% of the value in most cases.
Absolutely, and as Bryan said, there's the hefty down payment. They also want to see a lot of reserve money there because it is just simply the retirement account that has to keep that deal going. And the interest rates are not going to be, I think Bryan's quoting, the 5-6 range. You're not going to be at the 5-6 range in today's market on the non-recourse. You're probably looking at more like maybe 8% as a best case scenario, and probably higher. Perfect. So a lot of great questions today, guys. Again, Bryan Maddex, Amerifirst, phenomenal resource, especially if you're in the Carolinas and Florida. Certainly any other thoughts, questions, love to get feedback. If you have ideas for additional topics, as you've seen, this is kind of a new model that we're rolling out where we're trying to bring in experts on different topics to add additional value beyond what I can certainly provide there. So again, Bryan Maddex, great lender. He's an investor as well, as he mentioned, so he can add value, and he understands these transactions from a lot of different perspectives. So thank you so much, Bryan. Really appreciate a lot of good value here today.
Sean, thanks for having me, man. And if you guys have any questions, please, even if I'm not involved in the transaction, I'm always happy to act as a resource and try to help you out. So feel free to contact me if there's anything I can do to help.
Perfect. All right. Well, thanks so much, everyone, and hopefully we'll see you at something else here soon. Have a great day.
Thanks all.